Good morning, everybody, and welcome to another virtual investor event hosted by NZX. My name is James Sharp from the issuer team here at the exchange. Hope everyone had a pleasant weekend. Some good rugby results for the ABs, clearly. Not so much if you're from my part of the world, but alas, we can't have it all. Just a reminder of format, we're going to hear 3 presentations today from our listed issuers, each lasting around 15 minutes. After each of those presentations, we'll have 5 minutes or so for Q&A. To ask a question, please do so via the webinar panel. There's a free text field in there where you can ask anonymously. And anything we don't get to today, we'll get answers over to you after the session. Okay, without further ado, it is a delight to welcome our first presenter. Simon Woodhams is Chief Executive of PFI Property for Industry. PFI first listed on NZX in 1994 and is a listed property vehicle specialising in quality industrial property in prime locations. A very good morning to you, Simon. And I'll just wait till your presentation comes up just to confirm we can see it all correctly. And then I'll hand over the reins to you.
Hey, James, how are you? Thanks for that introduction. We're just bringing up the. Can you not see it? My presentation.
Not yet, no, but that's okay. We'll wait until we can see it. We have a backup in case that's not working. Okay. Anna, who's the person in the background who's supporting from a technical. Oh, here we go. No, there we go. At the end, at the last minute, there we are. I can see it and I can hear you loud and clear. I'll hand over to you, and I'll be back in a few moments with some questions. Thanks, Simon.
Perfect. Thanks, James, and thanks again for having us. I think this is the 3rd time we've done this in the last couple of years, so it's great to be back. Thank you to everyone who's listening in this morning. We appreciate you giving up your time to hear about what we've got to say about our company, Property for Industry, or PFI, as you may know us. I'm just going to give a very high-level overview about what PFI is, where we've come from, and then run you through some of our recent interim financial results and speak to some of our current initiatives that we've got going on at the moment. And as James said, there'll be some time for questions at the end if you have them. So as James said, PFI is an NZX listed property company. We focus solely on industrial property. We were established back in 1994 and listed back in 1994, so it's been around for nearly 30 years, which is something we're very proud of. New Zealand owned, again, something we're proud of. We currently have a well-located portfolio of 93 properties that's leased to 128 tenants. Probably the key point I'd take out of this slide here is that as at June 30, the portfolio was valued in excess of $2 billion. So therefore, we're a property company of scale. The portfolio is currently 100% occupied, and we have a weighted average lease term, or a WALT, of 5 years. We take this as a good indication that the buildings we own are fit for purpose and continue to be attractive to the wider leasing market, which is very important. The company has a reputation for having a clear low-risk strategy. Our current company gearing, or level of borrowing, is just 29%. Our strategy is executed by an experienced management team, many of who have been involved with the company for 15 years now. The team here at the office covers all aspects of property ownership and management, from sourcing new deals and opportunities, be they acquisitions or developing new buildings, through to financing and the ongoing management of the assets themselves. We're a professional team that takes the ownership of our buildings very seriously, a real cradle to grave type approach to owning the properties. The majority of our portfolio, well, 85% in fact, is located here in Auckland, which we see as the strongest and deepest market in the country. The balance of our portfolios is spread throughout New Zealand, which we also see as important, as it allows us to work with some of our larger clients or tenants who may have requirements across a national footprint. The rest of this slide highlights some of the reasons why we love industrial property. At an average size of 8,400 square metres, our properties tend to be smaller and more generic in nature, as opposed to other asset classes such as office towers or shopping malls. This means that they're more liquid and can be bought or sold more easily. Industrial property tends to be occupied by a smaller number of tenants, typically 1 tenant per property, which in turn makes them less management intensive and more cost effective to run. And finally, due to how they're constructed, typically single level, smaller offices with concrete and steel warehouses out the back, they require lower levels of ongoing capital expenditure to maintain them, and they tend to have a lower seismic risk, which we see as being important. That's a little bit about the background of PFI. Next, I'm going to spend a few minutes on our recent interim financial results and the key dynamics we're seeing playing out in the property market at the moment. So firstly, looking at our recent results, in mid-August, we reported earnings that were broadly in line with the prior periods, being FFO and AFFO, or funds from operations and adjusted funds from operations. These are important measures that we use to calculate our dividends. As always, there's a lot going on under the hood of our financial result. However, one of the key dynamics playing out on the property side is that the Auckland industrial vacancy remains at historic lows, practically zero across both prime and secondary stock. The forecast supply pipeline, while of a meaningful size relative to historical standards, isn't expected to create enough product or cause vacancy to rise to anywhere near the levels that were last seen during the years that followed the GFC, largely due to the lack of available development land, particularly here in Auckland. These favourable supply-demand conditions have led to unprecedented growth in market rents over the last 18 to 24 months, with CBRE, who are one of Auckland's largest commercial real estate agencies, now forecasting market rental growth for 2023 in the range of 9 to 12% for both prime and secondary properties. And that's following on from growth of 17.4% and 13.8% in 2022 and 2021 respectively. This rental growth is expected to moderate in 24 and 25 before returning to more normal levels of around 3 to 5% in 26 and 2027. So our portfolio at the moment is at least 16% under rented, and the team out the back have been making good progress in terms of capturing these elevated market rents where possible. So during the first half of this year, our team leased almost 36,000 square metres of area, or 4.6% of the portfolio by rent, for an average lease term of 4.7 years. All of the leases completed during the first 6 months of 23 were renewals, and on average, just half a week of incentive per year of term was required to secure these transactions. That reflects the continued strength of the industrial market. Of the $4.4 million of contract rent secured during the first half of the year, rents were agreed on $2.2 million of contract rent, and these transactions were settled nearly 15% above previous contract rents. The remaining $2.2 million of contract rent secured is subject to market rent reviews on renewal, which are all uncapped. Those leases account for approximately 9% under rented at the end of the interim period, and have an average weighted review date of December 2023. Also during the first half of the year, we completed 61 rent reviews across $32.8 million of contract rent. Together, these rent reviews combined to achieve an average annualised uplift of 4.2%. And during the second half of this year, a further 45% of our contract rent will be reviewed in some nature. And we anticipate to continue benefiting from strong market dynamics outlined on the previous slides. As we would expect, sustainability is a key area of focus for us here at PFI. We recognise that we own and manage assets that will be around for the next 50 and in some cases 100 years. So we have the ability to influence how they impact on the wider community and the environment. At the start of 2023, we shared our refreshed sustainability strategy. Now, this strategy focused on 5 key areas of focus that are the most material for PFI, those being greenhouse gas emissions, resources and waste, disaster and climate resilience, people and wellbeing, and economic value. We committed to the targets set out on this slide. Firstly, we're targeting the implementation of power metering across 50% of the portfolio by 2025. This will enable us to understand the energy use of our buildings and work towards some form of green performance rating in the near future. Secondly, we will install solar systems at 5 of our buildings by the end of 2025. Third, we continue to minimise and offset our Scope 1 and 2 greenhouse gas emissions. And finally, significant new buildings that are developed by us will be targeting a 5 Green Star certification, which will help to future-proof our portfolio. When we look at our property portfolio, we split it into 4 categories or buckets. We do this as it gives us focus and enables us to act with confidence as the portfolio continues to grow. As you can see, all 4 buckets currently sit within their target ranges. An increasing area of focus, though, for the team over the last 2 years has been the redevelopment of the existing holdings we have, the brownfields bucket, so to speak. And on the next couple of slides, I'm going to touch on 2 major projects that we've got going on at the moment. The first is at 30 to 32 Bowden Road, which is a industrial precinct in Mount Wellington here in Auckland. As the drone footage on this slide shows, things are well underway on site with 2 new buildings being developed, where a 1960s obsolete manufacturing complex once stood. We've secured a pre-commitment for approximately 40%, or one of the buildings, the smaller one there on the right-hand side, with the larger building on the left-hand side being developed on a speculative basis. Both buildings will target a 5 Green Star rating, with close to 24,000 square metres of covered workspace or workable area once complete. The estimated incremental project cost for this development is $65 million, and we're targeting a Q3 2024 completion date for both warehouses. Our second key development project is located at Springs Road in East Tamaki, which is another key industrial precinct here in Auckland. As with Bowden Road, the initial phase of the Springs Road development is well underway. We have demolished and removed an older warehouse, and you can see there the civil and foundation works on the new warehouse is coming out of the ground. The existing tenant is Fisher & Paykel Appliances. They have committed to the first stage, or stage 1 on the slide there, of this significant redevelopment with a 15-year lease that will commence on completion of the works, which is targeted for January, February 2025. Stage 1 has an estimated total incremental cost of $76 million. And encouragingly, contract pricing has shown signs of easing as compared to our initial estimates. And consistent with our climate commitments, the Fisher & Paykel facility will target a 5 Green Star built rating. Finally, with 5.3 hectares of development land still available on the balance of the site, which Fisher & Paykel are still leasing and operating out of, we're actively planning the reconfiguration of future stages. Finally, just to close out my presentation, I just wanted to touch on a future project that we've recently announced, and this is the acquisition or land acquisition of some land in the Spedding Road Industrial Estate in Whenuapai, West Auckland. Earlier this month, we agreed to purchase approximately 5.8 hectares of land in 2 titles at the end of the Northwestern Motorway. The site's just opposite Costco, for those of you who know Auckland well. These sites will be delivered as part of a wider land subdivision and development estimated to be completed in mid-2025. And we'll be looking to develop 40,000 square metres of building area in 3 stages. The first stage will be coming out of the ground in 2026, and as with all our significant buildings of scale, we'll be developing to achieve a minimum 5 Green Star rating. So just to summarise, Property for Industry is an industrial property company of scale and quality. Industrial property is an asset class that continues to perform very well. Demand from our occupiers remains robust, particularly here in Auckland. And this is supported by record low levels of vacancy and strong rental growth. Pleasingly, our portfolio and strategy is benefiting from these strategies and dynamics. And looking forward, while there'll be some challenges, in particular interest rates, we believe that the PFI management team and company is well placed to execute on our current Green Star development pipeline, while at the same time remaining open to any opportunities that may arise. Thank you. That concludes the presentation. James, if you've got any questions there, feel free to ask away.
Thanks very much, Simon. Great presentation. And yeah, we got the presentation up in the end, which is good. Maybe it's a couple of questions from our side. Just earlier on in the slides, we saw the kind of supply and vacancy levels going off into the future to 5 years. So I was just interested to know how you calculate that sort of forward view. What drives how you see the industrial property market growing over the next 5 years?
Yeah, so these are slides taken from CBRE reports. So CBRE are one of the big, well, they're a global real estate agency, but they've got an Auckland office here, and they do a lot of research in and around this. So they actually go out to, CBRE go out and interview all developers, owners of land, to see what stock or what developments they've got on the books and when it's likely to come to market. So it's a pretty thorough piece of research that they undertake, and they do it on a quarterly basis. We subscribe to their research. So amongst a lot of information, that's one of the slides that we've pulled out.
And I guess off the back of that, do you also keep a firm eye on the kind of overall macro themes coming through the economy? Does it affect your sort of day-to-days or even month-on-month decision making?
Yeah, we cover a whole series of risks and opportunities. Maybe not on a day-to-day basis, but certainly on a monthly basis, the senior leadership team meet and discuss, themes that's going on out in the wider market. I mean, obviously, with COVID, the e-commerce trends is something that we've been tracking. Trucker meters, we track that to see, how retail spend's going, because ultimately that all flows back into demand for warehouse space. Another thing we do is we spend a lot of time, or we're very close to our major tenants. Our top 10 tenants account for about 45% of our income. As you'd expect, our major tenants include companies like DHL, Mainfreight, Fletchers, and the like. So we talk to them. We like to see, what are they seeing on the ground, and how's that flowing through into demand for our space, really.
Okay, great stuff. And then you've obviously gone through a few of the kind of properties in development, as well as that Hobsonville opportunity. So I guess a general question around all that stuff is, what and you may have touched on this already. How do you assess whether an opportunity is of good quality? What about a particular opportunity do you kind of look for before you make a kind of decision on it strategically?
So in terms of acquisitions, I guess you're asking, or the redevelopment piece, we target, quality location. I think that's probably there's the old adage, location. You can't change that. So we really target areas that we know there's going to be high demand. They tend to be ones around the motorway network, so close to motorway on-ramp, off-ramps, close to population. So the closer you are to central Auckland, you tend to be able to charge higher rents. So first and foremost, location for us is really important. If we're then buying an existing building, we look at things like how generic the building is. So if you have a tenant in situ and they move out, will you be able to release that building quickly? With very little downtime. Every day your building's not leased and not bringing in rent is a day you lose $1. So location, then the quality of the building, and then thirdly, if it is a leased building, what quality of income are you getting? Is it a listed entity that leases the building, or is it a global entity, or is it a small private business? So effectively you're assessing risk at different levels, and those are probably the key things: location, building, and then income quality. If we're redeveloping, we're targeting, again, what is best in class for a new building these days. It's a high stud facility with minimal office, full access for trucks to drive around the site, all that sort of stuff. So the basics that we do very, very well.
Fantastic. Okay, no, really interesting stuff. We don't have any other questions as yet, but if we do get some more, we're going to flick those over to you, Simon, directly. So yeah, thank you very much for once again presenting this morning, and see you in the not too distant future.
Okay, great. Thanks for the opportunity.
Cheers, Simon. Thanks. Bye-bye. Fantastic. Thank you again. So we're going to now move on to our second presentation today, which is from the first of our two tech issuers that we have on this morning. It is eRoad, and it is a delight to welcome Margaret Warrington, who's Chief Financial Officer at eRoad. eRoad provide a range of reliable and accurate fleet management technology solutions to their clients in New Zealand, Australia, and the US. A very good morning to you, Margaret.
Morning, James.
I can hear you loud and clear. We'll just wait for the presentation to come up on our screens. And there we go. There it is. So I'm going to hand over to you now, Margaret, and I'll be back in about 15 minutes for some questions. Oh, just before I do so, just to highlight which screen we can see. If you can see your slide screen where it says where it's the black background. If you just go up to display settings on that screen at the top, yep, and then you just if you could just swap that around, and then we can see your main presentation. Right, that's enough from me. Back in a few moments. Bye bye.
Thanks, James. Appreciate that. I can see the exact reverse on my screen. Hi, everyone. If you're expecting Mark, I'm clearly not him. I'm Margaret Warrington. I'm the CFO here. Mark, unfortunately, had a clash that he had to step out for, so I'm going to step in and cover for him. But if anyone has any questions, he's more than happy to get stuff directly as well. Please feel free to message through. I'm going to start with a really big number, 33 billion. In fact, it's almost 34 billion. That's the number of data points that EROAD collects on an annual basis to support our customers. It helps them better understand their fleets, their drivers, their cargo, and their impact on the environment and other road users. It's a really important step for us because those fleets travel over 9 billion kilometres using EROAD devices. And EROAD is a market leader in New Zealand and one of the top 15 brands in the telematics industry in the other 2 markets we play in. We're on track to achieve revenue of $175 to $180 million this year, and we're a very proud New Zealand tech business, and we're achieving on a global stage.
Margaret, sorry, Mark, just before you continue, we can just see the webinar control panel on your screen. If you want to just move that across so we can just see your presentation. There we go. Great stuff. Sorry for the interruption. Thank you. All yours.
Oh, hang on. Stuff that up. Apologies. James, can you pop back? Can you still see my slide deck?
I can see your front page. Yep.
And have you got rid of the control panel yet, or are you still?
Yeah. No, that's gone, and we'll just wait for you to maybe flick to the second slide so that works.
Next slide and check it works.
Yep.
That one?
Yep. Good. Oh, cheers.
Sorry about that, everyone. What I'm hoping to get out of this presentation for myself, but hopefully for all of you, is to show you that through a better understanding of our business, I'll show you EROAD currently offers a great investment opportunity. That's what I want to get out of this. So this is our purpose. We don't just track vehicles, we do much more than that. And it's reflected in our purpose. We want to deliver intelligence that our customers can trust for a better world tomorrow. Our systems integrate with our customers' systems and provide technology and real-time information so they can make real-time decisions. As we say on the slide, we're helping our customers run safer, greener, and more productive businesses. As an example, our most recent product launch is a decarb tool that helps our customers understand their carbon emissions. In a world that's becoming more and more data rich, telematics companies, including EROAD, are becoming more and more relevant. We've got 3 prongs to our purpose. As I mentioned, we want to do actionable insights and intelligence for our customers, but the end game to this is about helping our customers drive improved profitability. We're a trusted platform, and our customers need accurate data to drive their fleets. And we want to support a better and more sustainable future that's safer for our customers and the community. We're a hardware-enabled SaaS business. We sell integrated solutions to our customers. Our revenue comes both from selling our own and others' hardware. Alongside this, we get revenue from our SaaS subscription contracts. Our contracts typically cover 3, 4, or 5 years, depending on the size of the customer. We've got a variety of integrated solutions that solve different problems for our customers. They tend to congregate around a number of themes, so I'll talk to the themes. Compliance. This is all about paying for the use of roads. It's a very real issue for fleets and governments as vehicles get more efficient. Health and safety. Again, I've mentioned that already through the introduction, which is about making sure drivers and other drivers on the road get home safely. And in some instances, it's around exoneration where there is an incident. Productivity, it mainly relates to fuel and asset costs. We help our customers use their assets more efficiently and spend less money on fuel ultimately. And it's really, really important for our customers because they have very small margins typically. We also have a very strong offering in the refrigeration and construction spaces. Environmental impacts, I've talked to that through this, but we really want to help our customers understand their carbon emissions. This slide is designed to give you a sense of EROAD's size and scale. I started with one of the metrics on this, the 33.7 billion, but I also wanted to talk to, we have over 10,000 customers and we have over 370,000 people who interact with our products on a regular basis. We've just recently hit 100,000 units in North America, and we expect that region to continue to grow and to be our largest market in the next 1 to 2 years. We're a market leader in New Zealand, and we have premium priced products in all our markets, which reflects the value we provide to our customers. Our customers love us, and that's why we win business. We provide products to give our customers very specific and valuable return on investment, and that can be in regard to compliance and tax products, as well as the value we return to them that they can better control their safety and sustainability outcomes. We also partner with them for growth. If our customers grow, we grow. So we're continually looking at investing in enhancements that make sense for their businesses and help them with further insight into running their own operations. Above all, with over 370,000 users interacting with our system, what is most loved is how simple and intuitive our interface is. These are the fundamentals and foundations for our business. We've got the right product fit in the right markets. We've experience and we're ready to scale. This is the basis of why we see continued growth. The US telematics market alone is focused to grow to $20 billion by 2030. We've got a proven track record in New Zealand as a market leader, with our New Zealand business generating $41 million in free cash flow in the last financial year. That benefit of that mature and stable business is that it funds the significant growth opportunity in North America and provides us the capacity to grow. We have blue chip customers who have been with us for multiple contract terms and who achieve real ROI by using our product. Many of the businesses have been with EROAD for a long time. Mark, our Chief Executive, has been with EROAD for 8 years, and he has built an experienced and diverse management team around him, and we're ready to deliver on the strategy. Telematics is a growing industry. Our current strategy is focused on capitalising on the significant addressable market and opportunity provided by North America, but I'll briefly talk through all 3 markets. As I just indicated, the revenue in North America for telematics is forecast to double over the next 7 years. It's a very large market, and we play in particular niche areas to make sure we can be competitive, and they are refrigeration, construction, and professional trucking. We've already got 3,000 customers in North America, and it's currently our second largest market. But as I indicated, we're expecting that to grow to be our largest over the next 1 to 2 years. For New Zealand, as I mentioned, stable, mature market. We've got 6,000 customers, and although it's our largest market, we still have lots of room to grow. We continue to work with our customers to look at other needs and deliver to what they need in that market. And in doing that, we can penetrate further into their fleets. An example of this is our camera product, where it can be used in light vehicles to provide a health and safety solution for some of our customers. Sustainability will also unlock another wave of growth potential for us in that market. In Australia, that's our smallest market, but we've got some strong enterprise brands and we intend to leverage off those and some of the brands in New Zealand to help continue to grow our Australian market. We already have successful and trusted relationships with large referenceable customers, and that helps support EROAD into new opportunities. Over half of our connections are enterprise fleets, and these fleets tend to be over 500 units or more. The top 10 make up 20% of our revenue base. Our largest customers are mainly in North America, and last year we won Cisco, which is one of the world's largest food services distributors. We're currently rolling out approximately 9,000 units into their fleet and building integration and route management solutions to support them and their customers. We beat the incumbent and won against one of the largest telematics competitors in our industry, and it was due to the strength of our solution that we won this. In the telematics industry terms, it's like winning an Oscar. We've built up enviable range of brands in terms of our customer base and in the niches we operate within. And these marquee brands we expect to help us unlock further growth and further potential. Serving and winning enterprise customers is a key part of our strategy moving forward. So with the opportunities I've described, I want to also indicate how we're positioned to leverage on those. Our key focus for the exec team has been delivering sustainable, profitable growth. This requires both revenue growth and cost management to achieve it, and this will occur in the near term. In the meantime, we're making sure we provide market guidance that investors can have confidence in and that we deliver. We did this in the financial year 2023. From a revenue perspective, last year we exceeded guidance and delivered $165 million. We have strong contracted revenue of $220 million. We grew our units by 9%, and this year we've provided guidance that we're targeting $175 to $180 million in revenue. From a cost perspective, we've acknowledged we let our costs grow faster than our revenue, and we've, over the last 18 months, taken on a plan to make sure we reverse that position. So last year we took out $10 million on an annualised basis from the business, and this year we are on track to deliver a further $10 million. We now have a banking facility and headroom to fund our growth until we become free cash flow positive. On that, we've considerably reduced our cash burn from more than $4 million a month in the first half of the last financial year to $1.5 million per month in the first quarter of this financial year. We're continuing to see an improving trend in our cash burn as our revenue grows and we deliver the $10 million in cost savings I've just talked about. We've provided guidance that will be free cash flow neutral in the next financial year, that's 2024, which means during that year we'll become positive, free cash flow positive. Profitability, we've provided guidance this year that we're targeting normalised EBIT of $0 to $5 million. Lastly, with a reasonably complex operating and revenue model, we've been trying to focus on helping our investors understand our business and give some metrics that they can look to understand our value. Excuse me. AMRR, annualised monthly recurring revenue, reflects our cast forward of what we expect our ongoing revenue to be at any point in time, and we are targeting growth of 11 to 13% for that metric. That's in line with what we have done historically and also in line with what the market is expecting to do. Customer and asset retention are a key focus, and we have low churn and a high asset retention. Globally, we seek to have this at about 5%. As we grow our enterprise customers, as I mentioned, is a key part of our strategy. As we grow them into a higher proportion of our portfolio, we also expect to see longer contracts. Typically, they enter 60-month contracts. We've got clear targets in regard to our R&D, and we look at our return as we look at what we're investing in and what our customers need. And then lastly, as I've mentioned, we really want to focus on positive free cash flow and driving a free cash flow margin, and our target is 9+%. So we've got a strong, profitable market position in New Zealand and significant growth potential in North America. Like most tech companies, we have gone through our challenges. many of which have played out in our share price. Throughout all of those challenges, the underlying fundamentals of the business have remained unchanged. We're a company with great products that our customers love and provide huge value to them. We have deep expertise in data, technology, and telematics. The next step in our journey is here. We have reset and right-sized our business. We've set ourselves up for success in North America, and we're well positioned for future trends. We're investing in creating value for our customers so our shareholders can invest in us. Thanks, James.
Thanks very much, Margaret. Great presentation, really, really comprehensive. No questions from the audience, but as yet, but I do emphasise that anyone can ask a question by going in the free text field. You can ask a question if you're watching a recording of this, and you can still cycle that through. Maybe a couple of questions from our side. Focus on North America, very well understood, and that really sizable opportunity there. I mean, maybe looking through the lens of that key win, that recent win with Cisco. I mean, how do you approach these types of clients, these types of opportunities? Clearly a huge market. Is it a question of being kind of present with boots on the ground? How do you really kind of hook those key names into your kind of customer base, with Cisco perhaps being an example?
Okay. Look, ultimately, having those referenceable customers is really, really important to us, because in the telematics industry, people understand who each of the large players are using. But we do have boots on the ground. We do develop relationships. We have a very clear marketing strategy that's targeted at the enterprise customers we want to win, and we work to make sure our solutions meet their needs. So it's a very targeted approach, and from our perspective, but the opportunities can come both from our knowledge or through referrals, which is why we focus on ensuring our current customer base gets great service.
Great, thanks, Margaret. And then secondly, just I guess is a question more to do with the technology product solutions and the products you provide, and perhaps leaning in a little bit into that kind of R&D spend. I mean, how critical is it to produce products that are of the tech of today? I mean, presumably the tech itself is constantly changing. So, yeah, how do you maintain, I guess, the relevance that the solutions you're providing are really addressing a problem in the kind of 21st century, so to speak?
Yeah, look, I think there's a combination of things. There's listening to our customers in terms of what they need in their business, and there's an eye to the future. So as you can imagine, in the tech industry, you're looking out into the future to say, what can you see coming? What can you use? What can you leverage? So I'm not the expert in it, but that decarb tool that we've just released used AI as part of the work program to deliver that. And so we are looking at what's happening in the tech industry, but we're also listening to our customers, because they are often the best source of, this is what works well, this is the next business problem we want you to look to solve. So we've got a product team that's both North American and New Zealand based, and and Australian based, but they look and talk to our customers to understand what problems they need solved, and we work from there.
Fantastic, that's really, really great answer. Okay, we'll leave it there, Margaret, because I think we're out of time. But then I do emphasise, do send those questions through. Thank you very much, Margaret, to you and for presenting this morning, and I hope to see you again in the not too distant future.
Thanks, James. Appreciate the time. Thanks, everyone.
Thanks, Margaret. Fantastic. We are now on to our third and final presentation of today, which is Raycon, and we're going to hear from Sinan Altug, Chief Executive of Raycon, who is on the screen now. We'll wait for the presentation to pop up there. Raycon is one of the world's largest manufacturers of frequency control products and timing solutions. Their products can be found at the heart of many applications, from 5G networks to satellites, and from emergency beacons to autonomous vehicles. Hi, Sinan. The presentation, we can't quite see that yet. There it is. And maybe you could just change one of the slides, just make sure that's flicking through correctly. But I'll...
Sure. Yes,
yep.
Sure. Hi, James.
Yeah.
Can you
Hi,
see it?
Sinan. Yeah, we're all good. It looks great. I'm going to go away now. I'll be back in 15 minutes or so for some questions. Thanks, Sinan.
Okay, sure. Yeah. Hello, everyone. Today I'm going to talk about Raycon. We are in our blackout period, so I'm not going to be able to talk about our financials at this point. But I think most of you would have heard the Raycon name over the course of the years. But we have also evolved a lot over time. We are not a startup, but a profitable tech company that has grown profit for the last 4 years. In FY23, we delivered a net profit of 23 million and declared our fully imputed dividend, a maiden dividend of 1.5 cents per share. Today, I will recap who we are, what we do, and how we continue to innovate and create value in the high-growth tech markets. So Raycon is a true Kiwi tech pioneer that is a leader on its own technology niche globally. We have a 50 years history enabling the next wave of technology. Since 1967, innovation is in our DNA. So what do? We design and manufacture frequency control and timing products, which effectively provide the heartbeat to all electronic systems. And just like the human heartbeat, they need to be ever present, accurate, precise, consistent, and reliable. Our products have provided the necessary heartbeat for a wide range of applications, from telecommunications to space exploration, and have been enablers of multiple technological revolutions. We have introduced over time, this gives a history, I'm not going to go into all details here, but we have introduced many industry firsts, and our innovations have been used in numerous tech quantum leaps, from cellular phones to GPS navigation, to 3G, to 4G, now 5G, and soon 6G. Also cloud computing, autonomous industrial equipment, and soon autonomous vehicles. And last but not least, next generation AI hardware, which I'll touch on a bit later, is using our products as well. So here are some examples of practical applications of our products. This is a 5G cell tower. You would see this around New Zealand and millions around the world for that matter. We have a multitude of products that go into the cell towers and the wireless network architecture. Our products play a crucial role in these networks. Once again, they ensure that data is transmitted faster, accurately, and reliably. And moving on to space, what you see here is the Mars Perseverance rover, which is currently exploring the Martian surface. We have multiple products on it. And similarly, our reach extends to many space missions. We have a number of products on the recent moon lander. We have also a number of products that are on the way to Jupiter on European Space Agency's JUICE mission. These demonstrate our position as a global leader in our field and our commitment to innovation and quality. This gives our customer snapshot. You will see that this is a list of who's who in tech, including some of the largest global tech companies. And what is important is that 2/3 of them, we have a business relationship that goes for 10 years or longer. This doesn't happen overnight. These are all enduring relationships, and not a coincidence, but a result of our unwavering commitment to delivering innovative, high-quality products as the global leader in our field. Moreover, these actually speak to our strategic execution as well. Having a customer list like this reflects our ability to understand and anticipate our customers' next generation requirements, adapt to market shifts, and remain dedicated to our strategic growth initiatives and our strategy. And touching on to our core markets, we participate, as I said, in high growth, high tech markets. More than half of our business is in telecommunications, followed by space and defense and positioning. While we have some challenges in FY24, FY23 was a remarkable year. The best ever for our core business with continued growth in all of our core business segments. And as I mentioned, in FY23, we paid our maiden dividends. The board deemed appropriate to commence dividends with a fully imputed maiden dividend of 1.5 cents per share. Now, our strategy, our long-term strategy and trajectory is designed to continue to build value and continue to innovate. It's quite simple, not rocket science. It is simply centered around 4 key pillars. Grow our core business and build on the telecom, space and defense, and precise positioning sectors where we have leadership. Maintain product leadership through continuous innovation and technology. And we are always looking into new markets to expand into, newly forming high growth markets to embed ourselves into early enough and be a market leader with our technology. There are many examples of this. The recent one is the new space low Earth orbit commercial space market. And also deliver world-class manufacturing. Once again, we are a profitable tech company that is also manufacturing products. And it does require us to be able to scale up our global capacity, implement advanced supply chain management measures, and other measures that allow us to excel in manufacturing as well. And in addition to these 4 pillars, we continue to explore strategic acquisitions that support our growth strategy. And matching our strategy, we have key milestones outlaid for 3 years. For FY23, we have achieved all of our FY23 milestones, and we are currently making good progress with our FY24 milestones. And one of our strategic priorities was to build and open our new Indian factory. It's located in the fast-growing aerospace hub in Bangalore, India, Bengaluru, with its new name. This is our manufacturing center of excellence. It is one of the largest and most sophisticated sites for advanced frequency control and timing solutions. This both future-proofs and signals Rakon's long-term commitment to world-class manufacturing. And it's fully functional. We have moved all our staff, commissioned all our equipment, and we are up and running. And moving forward, I just want to touch on 2 of our key technologies that are both homegrown. Just a glimpse of these critical technologies. The first one is our XMEMS nanotechnology. This refers to our advanced resonator technology, homegrown right here in New Zealand. It uses a process very similar to semiconductor chip processing. It's nanoquartz photolithographic microfabrication. Now, what does that mean in practical terms? It means that we can develop next generation products that are smaller but perform better, which cannot be manufactured by traditional methods. This is a game changer in the frequency control and timing industry, and already being used in a multitude of next generation applications. Another key technology that I want to highlight is our self-designed semiconductor chips. These are designed in-house at our UK facility, which we recently moved to Cambridge. The development and production of our own semiconductor chips align very well with our strategic focus and maintaining a product and technology leadership. By designing our own chips, we accelerate greatly our time to market and are able to adapt ourselves and deliver next generation products and performance quickly. this allows us to stay ahead, as I mentioned before, stay ahead of both technology and product offerings in our own technology segment. And products using our own chips contributed to 45% of our FY23 revenue at substantially higher average margins. And this is my last slide. As I conclude, I'd like to highlight the future growth and value drivers for Raycon. Our vision is not just about now, present, but it is the long-term strategic alignment that focuses on growth in high-growth markets. FY24 has presented its challenges, as I mentioned, in specifically our telco and positioning segments. But when we look at our long-term prospects, medium to long-term growth fundamentals and drivers remain strong, with significant market opportunities for us in both core and emerging markets. We are working very closely with our telecom infrastructure customers. That's where I'd like to start with, helping enable actually the evolution from 5G into 6G architectures. We have a really good position in the next generation platforms, and lots of market opportunities. And we are also particularly excited about the growth prospects in aerospace, but in emerging markets such as new space, cloud computing, autonomous vehicles. There is quite a lot of growth in all the areas that we have placed ourselves in the middle of and be a part of the ecosystem. And I also want to touch, we get this question all the time, what is our presence and contribution to artificial intelligence? It's a key area that we have been focusing on for a number of years in the background. It's not just a buzzword for Raycon. It is actually, there is a significant tie into our next generation technology in enabling next generation AI hardware. As AI evolves, the demand for dense, real-time parallel processing is increasing because real-time parallel processing allows substantial benefits in terms of processing efficiency and power consumption, but it requires very tight timing accuracy. So this requirement for synchronization, which is crucial for real-time parallel computing, aligns perfectly with Raycon's expertise and our capabilities. We are actually focusing in precision timing. So we're in the middle of this AI trajectory as it's moving forward. We're actively collaborating with the leading players in the AI space and enabling next generation platforms. We'll be able to talk more about AI in the coming quarters. In closing, I just want to say that Raycon is a testament to the Kiwi ingenuity and resilience. Our strategic focus on technology and innovation, our dedicated global team, and our strong company culture is allowing us to create sustainable value for our stakeholders. And we're really excited about the future, and we are doing our part in shaping it. And we would love for you to be a part of it and share our progress in where we are going, our journey, and perhaps you being a part of our journey as well. Thank you.
Thanks very much, Sinan. Fantastic presentation, and here there's a here to in terms of taking Kiwi ingenuity to the world. I always almost kind of in disbelief when I see about the Mars rover and things flying off to Jupiter with your products on. I think that's a great testament to Kiwi ingenuity via yourselves. A couple of questions. I guess one, great explanation of the kind of use case of your product, but just to reiterate on that. So the advanced timing control and frequency control, it sounds so this is the critical way in which systems talk to each other or networks talk to each other because it's reliant on timing? Presumably, without that frequency control, without that accuracy, the system just doesn't function. Would that be a very, very dumbed down version?
It would be. I think that's a good explanation, actually, James. But what I would say is that when we look at I can give an example of wireless communication, for instance. You could just think of a scenario where on your phone, you are looking at some bytes of data exchange between you and someone else. It's very easy to send that over. It will get there, and it does not require high-performing timing specifications. But when you look at sending a big amount of data, a big bandwidth of data, and move that through, have it flow through the network, it does require all those network nodes to be synchronized or timed as close as possible to each other. That allows faster flow through the system. Similarly, if you think of AI, you could, most of the AI systems right now are running in an asynchronous way, that you send your data somewhere, it's being processed, it comes back to you. But where it's processed, as the requirements, the processing requirements increase exponentially, for an order of magnitude difference in processing power, having that data flow smoothly like water through your processing gives a much bigger efficiency, and it has huge power benefits, power consumption benefits as well in data centers, for instance. So yes, systems do communicate. It doesn't have to, not everything is synchronized, but synchronization does help.
Thanks, Sinan. That was a great explanation. Thanks for kind of going through that again, making sure my understanding was on the right lines. A couple of questions from the audience, if I may. So this is probably leaning into the kind of the short-term, I guess, macro environment. So the question is, Nokia has recently announced a significant slowdown in 5G sales in the US, also slowing in Europe, and slower FG deployment in India. How will this impact Rakon?
Yeah, so from our side, as we have also announced earlier, that slowdown does have an impact on our telecom business segment, because those big customers, those big companies that are announcing such challenge, such as Nokia and Ericsson, effectively are our customers. So there has been a compounding effect in terms of inventory correction by our customers, but also operators, which are our customers' customers. So operators that I'm referring to are our customers. I shouldn't give any names, but a telecom infrastructure company has as their customers operators, obviously. Operators taking a bit more conservative stance, meaning that they are rescheduling a continuation of a 5G rollout, for instance, in a particular geography. If the operator reschedules it from 23 to 24, that does have impact on our customers, which trickles to us as well. And that is along the lines of what we have also announced. And these recent announcements does also show that it has the potential to control for a while longer. But on the flip side, other businesses such as space for us is actually going quite well.
Great to hear. Second question here is I'll just a request for a comment around the new CFO. I don't think there's a question as such there, but I think just anything to add, or just to reiterate in terms of the CFO departure and recruitment of a successor.
Yes, sure. I think we're first of all very happy that Drew joined Rakon. Drew Davies, he has a wealth of experience applicable experience for the path forward for Raycon. It's again, I think we should see it as a matter of companies evolving, strategies evolving, and I think from our side, our path, I think, aligns quite well with Drew Davies coming on board. So I'm very happy. And I wish, of course, our ex-CFO Anand Rambai all the best. We have had a very good relationship with him as well.
Great to hear. We are just out of time, so and just for anyone who has other questions to come through, we will get some answers over to you directly. And I've just lost you, so where are you? There you are. So I think we'll leave it there because we're just after 12. So Sinan, really great presentation again. Thank you so much for joining us this morning and giving us an update on Raycon.
Thank you very much.
Thanks, Sinan. And yes, just to reiterate, any other questions we didn't get to, we'll get answers over to you after today. Thanks everyone who's joined, and obviously a special thanks to all our presenters. We have 3 further virtual investor events between now and the end of the year, the next one being on the 8th of November. So please look out for an invitation kind of come through over the next few days. And yeah, hope to see you again soon. And yeah, enjoy the rugby at the weekend as well. Thanks everybody. Bye-bye.